development team here at Baird. So on behalf of your Baird advisors, I'd like to welcome you to this Baird Wealth Strategies webinar, Social Security and Your Future. In this webinar, our very own wealth planner, Ron Johnson, CFP, is going to guide us through the basics of Social Security, from how Social Security benefits are calculated to how it's factored in when creating your personal financial plan. So it's time to take a deep dive into one of the US government's largest benefit programs. But before I turn the call over to Ron, I have a few housekeeping items that I'd like to highlight. For optimal viewing, we suggest setting your layout to side-by-side view via the circle in the upper right corner of the screen. All participants are in a listen-only mode as of now, but we'd love to hear from you. We will host a Q&A session at the end of this call to address as many questions as time permits. You can submit a question by clicking the Q&A icon, so please be sure to address all your questions to all panelists. This presentation is being recorded and will be available along with the slide deck through your Baird Financial Advisor about a week following today's call. And we will also have the slides linked to the webinar information page, which is linked in the email invitation. And with that, thank you for joining us today. I'll now turn over the call to you, Ron. The floor is yours.
All right. Thanks a lot, Colin. I really appreciate it. Looking forward to running through this with everyone. So I always like to start out and put a little perspective with Social Security. If you were to have a benefit of about $30,000 a year, and if you were to live a nice long life into your late 80s, early 90s, that Social Security benefit is going to be the equivalent of about $500,000 to $600,000 in your 401k. So it's a big deal. It's a big piece of your retirement, and I know that's why most of you are joining today. So with that said, this is what we're going to do. We're going to cover the basics of Social Security for you. We'll go over the ins and outs of the program, let you know how the benefits calculated and all of that. And then we're going to talk about when you can begin taking benefits. And then there's some planning strategies and some benefits for spouses as well. We'll talk about that. And we'll talk about probably the most important thing, really the elephant in the room, if you will, is the outlook for Social Security itself. We hear so much about that it's going to be exhausted, it's not going to be there for me, all of that. So we're going to cover that in detail for you. And then finally, we're going to take off a presenter hat and put on my financial planning hat and discuss how we look at benefits as we integrate it into your retirement plan. So with that said, let's go ahead and get started. Okay, so the basics. And we're going to start with the very, very basics. How do you qualify to begin with? So in the United States, to qualify for Social Security, all you have to do is work 40 quarters. What does that mean? Well, every time in 2025, these 2025 numbers, that you earn $1,810, you get credit for a quarter. And you can earn up to 4 quarters per year. So essentially, once you work for 10 years, earning roughly $8,000 a year, adjusted each year for inflation, you're going to qualify for Social Security. Now, just because you qualify doesn't mean you're going to get a decent benefit, because benefits are based on how much you earn. Okay? So what happens is the Social Security Administration is going to go look at your earnings history over time. And they're going to adjust each of your earning years for inflation. So bring it up to 2025 numbers if they're calculating your benefit today. And then they're going to take your top 35 earning years. And with that, they're going to use that to calculate your benefit. Obviously, the more you earn, the larger your benefit's going to be. Now, it is front-loaded, meaning that lower earners will get more credit for their dollars than higher earners, but you still get more when you earn more up to a point. Now, in 2025, there's a term called the maximum credible earnings. And what that is that's the earnings point at which you stop paying the Social Security piece of FICA tax. Now, if you remember, FICA tax is 7.65%. Of that, 6.2% covers Social Security, and then the 1.45% covers Medicare. Now, once you hit $176,000 of earnings, you no longer have to pay the 6.2%. It also means that any dollar you earn above 176,000 does not go towards your calculation for your benefit. Okay? All right. Now, once the Social Security Administration determines what your benefit's going to be, that is called your primary insurance amount. Now, you'll receive that at what's called your full retirement age. For most of us on this call, our full retirement age is going to be age 67. Congress has been phasing up the full retirement age from 65 to 67 over the last 20 years or so. And you can see that those born after 1960 are indeed full retirement age at age 60. So that means that's when you get your full primary insurance amount. Okay. Now, doesn't mean you have to wait until age 67 to collect your benefits. You can start collecting your retirement benefit as early as age 62. But with that comes a haircut. So for each year that you decided to start taking your retirement benefits, you're going to take a haircut of roughly 6%, depending on exactly when your full retirement age is. So for instance, if your full retirement age is 67 and you decide to collect your benefit at age 62, you're going to take a 30% haircut on your benefit. Now, the longer you wait, the less of a haircut you have to take. So for instance, if you decide to claim it at 66, you're only going to take a little under a 7% haircut. Okay? Now, there's also benefits to waiting. You will receive what are called delayed credits if you wait past your full retirement age. And you can wait all the way to age 70. And you're going to get roughly an 8% increase in your retirement benefits for each year you wait. So if you wait to age 70, your benefit will grow by 24%. Pretty good. Okay. Now there's a couple other things to think about here. What happens if you're working and you decide to go ahead and collect your benefits? Well, first of all, if you start collecting at age 67, if your full retirement age is 67, so if you start collecting at your full retirement age, the only thing that happens is your benefit could possibly grow. And the reason why I say that is, remember, I mentioned that Social Security takes into account your top 35 earning years. Well, if you start Social Security at your full retirement age and the next year you happen to earn enough that kicks out a lower earning year, Social Security is going to take that into account and recalculate your benefit. So your benefit could grow while you're working and collecting. It may not. It may be that you have 35 higher earning years, and that's okay too. But we have to take into consideration if we decide to claim before our full retirement age and we want to work. The rules state that if we start to earn more in 2025, more than $23,400, we're going to have to start taking a haircut on our benefit. And the rule is that our benefit's going to be reduced $1 for every $2 that we earn over $23,400. So let's see what that looks like.
Hey, Ron.
Yeah, you bet.
Just one question from the audience. When you say the 35 highest years, is that consecutive years, or is that just the highest 35 in no particular order?
Yeah, it's a great question, Colin, and I'm not sure who asked it, but it's a very good question. Each year is adjusted for inflation, and they're going to take the top 35 in any particular order. So if you worked 40 years, they're just going to go through and pull out your top 35. There's no sequential order there.
Great, thank you.
Yeah, you bet. Okay, so let's take a look at, let's put some math to this. So let's say that you're only 64 and your full retirement age, in this instance, is 66. Probably likely that your full retirement age is probably 67 at this point. But let's just say you're 64 and you earn $30,000 for the year, working part-time, and you started collecting Social Security. In this example, you're collecting $12,000 a year. Well, in this example, our earnings exceeded the limit of $22,320. So we take our earnings, $30,000 minus the $22,320, and we get $7,680 over the threshold. Now, for every $2 we earn, our benefits reduced by $1. So we take that $7,000 number, divide it by 2, and that means our benefit is going to be reduced by $3,840. Now, I know this slide says lost benefits, but not really. What happens is that $3,840 is actually moved forward, and we're going to get it back as delayed credits when we hit our full retirement age. So not necessarily lost, but not received for a few years. Now, as a financial planner, let's talk about one of my favorite things. How is Social Security taxed? Now, Social Security is what we call a tax-advantaged income, meaning you're not going to pay 100%, you're not going to pay tax, let me put it this way, on 100% of your benefit. Worst case scenario, you're going to get 15% of your benefit tax-free. And that's for someone who earns $1 million. They're still going to get 15% of their benefit tax-free. However, if you're lower income, you could get all of your Social Security tax-free. So this is how we figure it out. We look at what's called provisional income. So provisional income means is that all of the other income I have besides Social Security, we're going to total that up, and then we're going to add in half of our Social Security benefit, and we're going to add in tax-exempt interest. And if we're a married couple filing joint on a return on our return, and it's less than $32,000, that means that our Social Security is tax-free. If we're somewhere between $32,000 and $44,000, our benefit will be somewhere between 1% taxable to 50% taxable. And if our provisional income is over $44,000, that means our benefit's going to be somewhere between 50% taxable and 85% taxable. Colin, were there some questions that were starting to filter in?
Yeah, so it looks like there are quite a few, which is great. So we have one participant asking, what is included in earnings dividends, or are dividends included in earnings?
Yes. Yeah. So basically everything's included, including our tax-exempt interest. So dividends, capital gains, interest income, all of that other stuff gets totaled in there. So essentially it's all of your AGI, but only half of your Social Security benefit.
Got it. And so earnings is active, not passive investments?
It would be both. So I think
Okay.
the term passive activity refers to real estate earnings, typically. In that instance, yes, you're going to add that in as well to the income that is counted towards figuring out how much of your Social Security is taxable.
Gotcha.
So
Perfect.
any other questions out there so far?
Yeah, so one we have is, If I was to sell a huge amount of stock with a $1 million plus capital gains tax, should I sell at age 70 to not affect my Social Security benefits that I am already collecting?
You would, the answer is no. The short answer is no. Go ahead and sell it when you feel prudent, because at age 70, you're still, uh, you're still going to impact your taxable Social Security. Now, maybe there's some confusion here. Income that we receive from investments doesn't impact how much our Social Security benefit is to begin with. That's only the only thing that affects our Social Security benefit as far as the amount of it is earned income. So that's going to be income that we receive from employment and income that we receive from being self-employed. So other types of income, such as interest, capital gains, don't affect the amount of your benefit, but they do impact how much of it is taxable. Now, in that question, Colin, if you've got $1 million in assets, likely the amount of dividends and capital gains while you own it, so capital gain distributions, are probably putting you over the threshold to where the majority of your benefit, 85% of it's taxable anyways. So whenever you sell those benefits, it's probably not going to have a huge impact on your Social Security. So Colin, were there any other questions?
Yeah, and so just a clarifying question. Is the $23,400 annual earnings only earned income, or does that include retirement pensions?
It does not include pension income. It is only earned income. So when we say earned income, that's income that's subject to FICA tax. So through employment or through self-employment. But pensions do not count, so you're good there.
Okay.
Any other questions, or should we move on?
There are a few more, but we can ask those a little bit towards the end, if that's okay with you.
That sounds good. I'll be happy to address those at the end. So let's move on. So we're still talking about taxation of Social Security. Now, what I was talking about is taxation at the federal level. Now, at the state level, it's even more tax advantaged because most states, except for 10, do not tax Social Security at all on the state level. There are 9 states that don't have income tax to begin with, so of course Social Security is also tax-free. But there are 10 states that still tax Social Security. I would tell you that those states probably make it up in other ways. Maybe you have lower property taxes, maybe lower income taxes, so forth. So, all right. So Congress was busy last year, and they passed what's called the Social Security Fairness Act. And my guess is we have a few people in attendance that work for the federal or for state government. And therefore, typically in the past, when they qualified for a federal pension or a state pension and didn't pay FICA tax on their earnings, they weren't eligible for Social Security. It fell under 2 rules, WEP, the windfall elimination provision, and GPO, the government pension offset. Those 2 rules reduced benefits. Well, the recent legislation that's passed in the last year removed both of those rules. So now, if you work for the federal or state government, it's our advice to go ahead and contact the Social Security office and see if you indeed do now have a Social Security benefit, because you may very well do. So take that into account. Now, we've talked about benefits. How do we apply for them? And I'll tell you, for the federal government, this process is remarkably easy. There are 3 ways to do it. You can call, or you can go in person, or the preferred way, at least in my mind, is to simply go online. You can create an account, or if you have already created one, sign in, 2-factor authorization, okay? And simply put in some identifying information in there and go ahead and apply for your benefits online. Really easy to do. So pretty simple. The spot you go to is ssa.gov. Now that we've covered the basics, let's talk about when to begin taking benefits. There's a myriad of claiming strategies here. So, should I take it at 60? Should I take it at 67? Should I take it at 70? Really great questions. So let's talk about why would you want to take it early? Well, sometimes people don't have a choice. They might have been laid off of work. They don't have enough other savings to support their lifestyle. They need the income. So they're going to have to go ahead and take it. But the way I look at this is if you delay to 70, all the way up to age 70, instead of taking it at 62, that's 8 years that you didn't claim benefits. But your benefit's going to be much larger at age 70. So the question is, how long does it take the much larger age 70 benefit to make up for the fact that you didn't claim benefits for 8 years? And actually, the answer is very similar to most people. It's your early 80s. 81, 82 years old. By that time, you've made up what you didn't collect starting at 62. So the way we think of this is, if you have reasons why you think your life expectancy is going to be shorter than normal, I would go ahead and claim as soon as possible. Now remember, you might have to take a haircut on your benefit if you're still working. Once you hit 67, we don't worry about that. You can go ahead and claim it. And if you're expecting a long lifestyle or a long life expectancy, you would probably want to wait until age 70. There are other reasons. We'll talk about that more towards the end of the presentation. But this is on the face of Social Security, the reasons why you may want to claim early as opposed to maybe taking delayed credits and waiting till age 70. Now, this graph kind of illustrates this. Basically, what we're looking at is a break-even point. At what point does your age 70 benefit eclipse what you would have claimed from your age 62 benefit? And it's right around age 80. So at that point, your larger age 70 benefit is gravy. The longer we live, the more it becomes beneficial. All right. With that said, our spouse is eligible for benefits based on our earning record. And vice versa. We're eligible for benefits on our spouse record too. And not just spouses, ex-spouses, and even parents if they're dependent on you. So if you're providing more than 50% of their support, they may be eligible for a benefit as well. I think that in this term, we're looking at survivor benefits. We'll talk about that in a minute. But ex-spouses are also eligible for benefits as well. We'll get into that. All right, so benefits for the spouse. So first of all, if your spouse stayed at home, raised the kid, federal government recognizes there's value to that. And they are eligible up to 50% of your benefit, of your primary insurance amount, the benefit that you will collect at age 66 or age 67. So they would get up to 50%. Now I say up to 50% because if the spouse starts claiming a spousal benefit before their full retirement age, they're going to take a haircut on the spousal benefit. Now, how this works, it falls under what's called the deemed filing rule. So when I file for Social Security, the Social Security Administration will have deemed that I have filed for both my spousal benefit and my retirement benefit. And they're going to give me the larger of the two. It's that simple. Now, I'm not eligible for the spousal benefit until my spouse indeed starts claiming their benefit. So it could be if I want to take my benefit early, I start collecting my retirement benefit. And then when my spouse starts, I'll switch over to the spousal benefit if it's more than my retirement benefit. Okay. Now,
Hey, Ron.
yeah, you bet, Colin.
Hey, and this just seems like it's on topic, but we have a question from the audience. So can a 65-year-old wife claim her own benefit even if her 68-year-old husband doesn't claim his benefit, which would be more than twice her benefit until he is 70 years old? And then can she switch to half of his benefit when he starts to claim his benefit?
Yes. So now if in this instance, I think you said she, if I recall correctly, but I could be wrong. He or she, if she or he claims their benefit at age 65, that's likely under their full retirement age at this point. So therefore, they're going to get a little bit of a haircut on their retirement benefit for doing that, but they can collect their benefit, their retirement benefit, all the way up until their spouse hits age 70 and they start collecting their benefit. At that point, they'll be eligible for the spousal benefit. Now, it's important to note here, Colin, that you get 50% of their full retirement age benefit, not their age 70 benefit. So even though your spouse waits to age 70 and gets their age 70 benefit, you're going to get half of their full retirement age benefit, which will be less. And if the half is larger than your retirement benefit, you will get that. Otherwise, if your retirement benefit is larger, you'll get that. Okay, so
Thank
in
you.
addition to, are there other questions, Colin? I should take a breath here.
Yeah, there's a few more. One is if I take benefits at 62 and it's for earnings, does the reduction stop when I reach full retirement age, or does it keep going because I started early?
No, the reduction stops. If the reduction due to earnings, that'll stop at full retirement age. Now, the year you reach, say your retirement age is 67, your full retirement age is 67. The year you reach age 67, so let's say my birthday's in June, so in January of this year, my earnings amount increases quite a bit. If I recall correctly off the top of my head, a little over $40,000 before my benefit gets reduced. And my benefit in the year of my full retirement age is only reduced $1 for every $3 I earn over the threshold. Now, if you were working, say you took your benefit at age 62, and you were working and you had your benefit reduced the whole time, and then you at age 67, you're still working, your benefit will no longer be reduced by your earnings, but it'll also likely increase because now you're going to get those delayed credits that they took from you back. So like I said, it's not benefits that they lost because you're working. They're just pushing them forward down the line and you're going to get them back. Any other questions, Colin?
Yeah, well, thank you for that, Ron. One is military retirement pay included as earnings?
Military pay, yes. Military retirement pay, no.
And then is spousal Social Security income included in provisional income?
No, it's just what you earn. So what you as the beneficiary pay FICA tax on, not your spouse.
Okay, gotcha.
So my spouse could be making $300,000 a year. If I'm not working and collecting Social Security, I take no haircut.
Okay, gotcha. And then one more, and then we'll let you go on with the presentation. Are we assuming that the income amounts stated are gross income before taxes and Medicare deductions?
Correct.
Okay.
Yep. It's just gross earnings from uh, your employment. So what you pay FICA tax on, and that's going to be pre health insurance deductions, pre 401k deductions, all of that.
Okay. Awesome. Thank you, Ron.
Yeah, you bet. Okay, so we talked about spousal benefits. Now we're going to talk about survivor benefits. So as a spouse, when my spouse dies, at that point I will receive the larger of my benefit or what my spouse was collecting. In this instance, there's no haircut if my spouse waited to age 70. I will get their full age 70 benefit for the rest of my life as well, and vice versa. So if I pass away and I waited to 70, my spouse will get the larger of my age 70 benefit or her retirement benefit, which is ever larger. Now, a couple things to think about here. You can claim a survivor benefit as early as age 60. Now, you're going to still take a haircut for every year that you started early from your full retirement age. So at your full retirement age, you would get the full survivor benefit, and you're going to take a haircut for each year that you take it early, all the way down to age 60. However, here's the strategy. If I look at my retirement benefit, and I see that if I wait to 70, my retirement benefit will indeed be larger than the survivor benefit. What I want to do is go ahead and start claiming the survivor benefit as soon as possible and let my benefit grow to age 70. And then at age 70, I'll switch to my retirement benefit. Now, the thing to know here is, unfortunately, earnings still impact the survivor benefit as well. So the same rules apply. Now, not only do they have the opportunity to collect a spousal benefit from me, but so does my ex-spouse. And if I was in the MBA and had many spouses, all of them may claim a spousal benefit based on my benefit. Now, this does not impact me at all. Just not like that every time I have an additional spouse claim on my record, it means that my benefit somehow might be reduced or something. It doesn't. In fact, I won't even know that there's ex-spouses claiming on my record. But as soon as I turn age 62, ex-spouses can claim on my record if they're not remarried. Once they're remarried, now they have a new spouse. Okay. So ex-spouses, not only are they eligible for spousal benefits, but they're also eligible for survivor benefits as well. As long as they don't remarry before the age of 60. So as long as you stay unmarried before age 60, you can collect a survivor benefit from your ex-spouse. So something to think about if you're looking to remarry and you're getting close to age 60. Is there survivor benefits there? And would I lose those if I get married at 59? But remember, it's only valuable if the survivor benefit exceeds your own retirement benefit. Okay, here's probably the most important concept that we address, because you hear it all the time. Especially as a financial planner, we talk to clients all the time. And the first thing we hear is, I don't think Social Security is going to be here for me. It's a very common apprehension. We completely understand. Because right now, the prognosis is not good. Right now, for the first time in history, distributions are exceeding revenue being FICA tax, right? Baby boomers have now retired, FICA tax receipts have dropped, distributions have increased. That's part of the reason why the trust fund's being stressed right now. The prognosis is that the trust fund's going to be depleted in 2035 if nothing is done. Now, that doesn't mean Social Security goes away. That's the first important point I want to make here. If nothing happens and there's no longer a trust fund, current FICA receipts coming into the Treasury will cover about 80 to 85% of your benefit. So worst case scenario, you're going to lose 15%. But here's where I'm going to maybe get on my pedestal a little bit and talk about what I believe to be a reality. We have been looking at trust fund life expectancy all the way since the 70s. And all along the way, Congress has taken action to bolster the fund. They've done things like increase the wage that's subject to FICA tax. Right now it's at 176. In 2015, it's at 118. Before that, it was much less. So they keep raising the amount of wages that's subject to the Social Security piece of FICA tax. In addition, they've raised the for retirement age. You used to be able, you got your full benefit at age 65. Now most of us have to wait to age 67. They also got rid of a couple claiming strategies, the restricted application and file and suspend strategy. Both of those are now gone. And they've bolstered the life. And the reason why they do this, and this is the most important point, is 50% of retirees are 100% dependent on Social Security. If the program were to fail completely, we would be looking at mass poverty in the United States, at least amongst retirees. So Congress realizes this. I know we're often skeptical about their capabilities, but they understand this. They'll keep taking action, and we'll see the trust fund continue. So what can they do to improve things? Well, first of all, they can increase the FICA tax rate itself. They can go from 6.2% to something north of there. Now you see this 15% number. Remember, there's two groups that pay FICA tax. The employees pay 6.2% and the employers pay 6.2%. And if you're self-employed, you pay both. Congratulations. Now, so they can increase that rate. Colin, there's some questions so far. Be happy to pause a little bit here.
Yeah, so we're having a lot of engagement from the audience, which is awesome. So we do have one here. So it looks like, oops, sorry, just kept. Okay, so and you may have already touched on this a little bit, but maybe you can expand.
Yep.
How do you see the risk of Social Security benefits or enhancements like cost of living adjustments being diminished for people who are already collecting Social Security retirement benefits?
I see that risk is very low. Where the adjustments will come will be on the backs of the working folks right now, the ones that haven't retired. And well, I'll get to that in a little bit more here in a little bit, but we won't see adjustments like reduced benefits. I don't think that will happen. Now, I never say never, but this is pretty close to never as you can get. Are there other questions that we can address right now, Colin?
Yeah, so I would go ahead and go forward, and then at the end, I'll bring up some of these.
Perfect.
Yeah, some of these other ones.
Okay, very good. Well, I'm looking forward to that. Okay, so this slide simply says the longer that Congress waits, the more painful the action they're going to have to take, right? And that's pretty common sense. So the idea here is hopefully they're going to act sooner than later. Now, there are some solutions that are being bantered around there that really aren't going to have much impact at all, like reducing COLA benefits on current benefits by 1%. Have very little impact at all. So back to the question that we just had, Colin. You know, do we see Congress messing with current benefits? I don't think so. I'm not even going to mention some of these other solutions because they don't have much of an impact. But here are some of the things that would have a very large impact on the health of the trust fund. First of all, there's talk about for earnings above $250,000, they would be subject to FICA tax. Now, unfortunately, in this rule, those that pay the tax over $250,000 aren't going to see an increased benefit. This is truly, if you will, a tax on high earners to help lower earners. But if we did that, we'd increase the trust fund expectancy from 2033 to 2063. Big step forward. Or we could simply just remove the earnings cap altogether and just all earnings subject to the 12.4%, 6.2 employee, 6.2 employer, and that bolsters it on 32 years. Or we could just increase payroll tax up to 16%. That's the 12.4 up to 16.2, and that would fully fund it. There are other things that Congress can do as well. Let's see. We don't have the slide on, but I'll talk about it. One would be continue to increase the full retirement age. You know, when we were at 65, that's because a lot of labor in the United States was very labor intensive, physically intensive. And we retired at 65 and lived to the ripe old age of 73. That's no longer the case. Now we're living into our late 80s. In fact, in the United States right now, if you make it to age 65, you have a 40% chance of making it to age 94. That's the statistics. That's just not me talking. So Congress could continue to increase the full retirement age. As I mentioned, they can increase the amount of earnings subject to the FICA tax. That'll be another one as well. So those are some solutions that Congress can take. And I suspect that they will be doing so in the next few years. Okay. So we've talked a lot about the benefit itself. So what's the right answer here? And I guess I'll pause real quick again. Is there some questions we want to address now, Colin, or should we move forward?
We will go ahead and move forward. We're compiling some right now. So if you want to go ahead to analyzing your benefit, and we'll ask these at the end.
All right. Perfect.
Thank you.
So what's the right answer here? That's the next thing. This is the fun part, at least for me. But I'm a unique individual. I get it. Okay. So the first thing you want to do is figure out first, indeed, how much is your benefit? And I just did this a couple months ago. It's pretty easy to do. You can go to socialsecurity.gov, either create an account or sign in, and then get a copy of your statement. There's a couple things you want to pay attention to here on the statement. So this is what a statement looks like. These bars right here show what your benefit would be at each age that you would claim it. Now there's something to note here. These are estimates. This is what they believe your benefit would be. So if I'm 55 and last year I made $150,000, the Social Security Administration, when they're calculating my estimate, will assume that I continue to earn $150,000 every year up until age 67, or every year up until age 62, to figure out what my benefit will be. Okay, if they give you some other information here, survivor benefits and so forth. But the other important piece on your statement that you want to pay attention to is on the next page is your earnings history. Now there can be some errors here. Now you don't have to go and audit this down to the nearest dollar, but cruise through this and make sure that the earnings each year make sense to you and that they're close to what you indeed earn. If there's an error, you might want to fix it, especially if it's an error in your favor. Okay, so we start with benefit calculators. The one online at the Social Security Administration is very good. And the reason why it's good is because I mentioned that when you take a look at your statement, you get an earning or benefit estimate. That assumes that you're going to continue earning what you did last year up all the way up at age 67, where you can go online and use their calculator. And instead of making that assumption, you can start putting in some zeros for early retirement and see if that impacts your benefit or not. Okay, so there's some benefit calculators out there. I'd suggest the one at the Social Security Administration. Now, the question is, what is indeed best? I can claim from 62 all the way to 70. And the first thing we do is we look at your benefit in a vacuum, if you will. Just a Social Security benefit. Here's your benefit. Here's your wife's benefit. Here's your ages. What's the best way, given a long life, given a short life, what's the best combination for you and your spouse to claim benefits? When should you do that? So that's the first step. The next step is we want to start layering in how this all fits into your retirement plan. And when we're doing this, we're really thinking about tax. Because, Colin, if I defer my Social Security to age 70, that means I don't have that taxable income at age 67, 65, and so forth. That means I have more space in my tax brackets to realize other income, namely capital gains, or perhaps a Roth conversion, or maybe we have other income that's coming in, deferred comp, so forth. So from a tax perspective, we want to try and level out income as best we can, and Social Security is part of that combination. So that's a lot of times why we do suggest waiting to 70. And we talked about some resources available. There's also a publication the IRS puts out, publication 554. It's the tax guide for seniors, very helpful. And I believe with that, we have come to the end of the presentation, Colin.
Yes, so Ron, thank you so much for sharing your expertise here. Like I mentioned before, we've had a lot of great audience participation. I feel like we're going to have you come on every Wednesday at 12 o'clock Central and give this type of talk so that we can get all these questions answered. But we found a couple here, some that I will go ahead and post in our chat. But the first one I wanted to ask is we have an audience member that says that she just retired from teaching in February and she's receiving California State Teacher Retirement System benefits. She said her union informed her of the windfall elimination, but I have enough in my IRA and 403B accounts to not claim Social Security until I'm 70.
Mm-hmm.
She's 62. Should she visit her Social Security office and check her benefits?
I would, yeah, just to understand what is indeed coming. I love the idea of deferring to 70, but certainly there's some other things to consider there. So that's part of the equation. But yeah, the short answer to that question is yeah, I check with Social Security and see what the benefit's going to be, because it's been a nice windfall for her or him.
Awesome. And another question we have is, how do you strategize with business owners on having a higher wage to receive more Social Security benefits versus trying to save on payroll taxes? This would be for a client who has little retirement savings.
Yeah, that's a really good question, because there's a lot of things at play there. First of all, there's the earnings itself, right? Now, earnings over 176,000 aren't going to go towards building your retirement benefit through Social Security, right? So maybe that could be a cutoff. But the other thing you need to think about, especially for a small business owner, is the qualified business income deduction. So that's income above and beyond your salary. And you get I believe it's a 20% deduction off income too. So there's a couple things at play. What's the optimal number? That's going to vary from one business owner to the other. It could be that obviously with the earnings, that might give us some opportunities there for 401k contributions as well. So that's the third piece of it. I wish I could give a more specific answer to that participant, but we'd really have to sit down with them and take a look at their situation. And I would encourage them to reach out to their Baird advisor, and then the advisor can bring in myself or another one of the wealth planners to look at your individual situation. We'd be happy to do that.
Yeah, we're gonna put you on retainer here. We have another question. If you're eligible for the deferred Social Security benefit by having Social Security income reduced by work income, does that later adjustment happen automatically, or do you have to apply for that adjustment?
No, I didn't believe it happens automatically, but I just pay attention when you hit age 67. If you don't see an adjustment, you need to call the Social Security office.
And for those who wait beyond retirement age to age 70 to collect their benefits, is there any reduction of Social Security benefits for earned income or self-employment income?
There is not. So if you decide that you're 67, that's your full retirement age, and you want to continue to work, there is no reduction if you want to claim benefits at that point. Now, if you are working and you're claiming or not, your earnings actually could kick out a lower earning year as well, and could cause your benefit to increase.
Gotcha. So, how about if somebody works as a freelancer? Can they pay their Social Security fee as a
Yeah.
freelancer?
Yeah, so freelancer, gig economy, right? Typically you are compensated through either a 1099 or they just give you a check and then you report that income on the Schedule C on your return. When you report it on your return, you will also be subject at that point to FICA tax. Now, unfortunately, the bad news here is, remember I said that the employer pays 7.65% and the employee pays 7.65%. As a freelancer, you get to pay both. But if this makes you feel better, the employer part is deductible.
Awesome. What are your, and you may have touched on this a little bit earlier, but what are your thoughts about future means testing of Social Security?
So, if I understand correctly, what that means is higher earners would probably receive less Social Security. Um, I guess personally, not a huge fan. Even high earners paid into that trust fund all of their lives, and I think they should get a benefit back for that. Uh, I don't know if we're going to see means testing though. I think what we will see though is that higher earners are going to start paying more FICA tax. So I don't think though that we're going to see wealthy retirees um, see a reduced benefit. That's just my opinion. Who knows what will happen?
Sure. And a question about kind of the structure of the Social Security program itself. How does the FICA tax get invested and managed by the government? So if someone pays into the system their whole life, it stands to reason that the benefit should not be at risk. So can you kind of go into that a little bit,
Yeah.
if you
Well,
can?
your current FICA payment that you make this year doesn't really go into an account for you, unfortunately. Actually, where it's going is to current retiree benefits or beneficiaries. So my FICA tax that I pay this year goes to pay Social Security and Medicare for current retirees. Especially now where FICA receipts don't total distributions at this point. So they're having to take money from the trust fund to fund 100% benefits. So there's not really an account with your name on it that's invested. Now the trust fund proceeds are invested. I think they're invested in U.S. Treasuries.
Got it. Thank you for that. We have time for just a couple more. Can you apply for Medicare and defer your Social Security benefits? And where do you recommend getting information on Medicare?
Well, very good question. So Medicare is something that we handle here at Baird. We can walk you through the program and how it works. So contact your advisor. Actually, that's a program that I run as well. Not Medicare, but the education of such. But yes, you can at age 65. There's some exceptions to this, but at age 65, you need to sign up for Medicare. Okay. You have an initial enrollment window here, 3 months before your 65th birthday, 3 months after your 65th birthday, and a month off, 7 months. If you don't want to claim Social Security at that point, you don't have to. You can continue to defer Social Security up to age 70.
Got it. And then Let's do one more question here, or maybe a couple more. When the benefits get reduced for being above the earned income limits, when does this reduction get applied? And how long will this continue until Social Security reviews to see if the reductions should still be applied?
That's a really good question. And don't quote me on this, but I believe it's month by month. So if you exceed the limit in 1 month, your benefit will be reduced a little bit the next month. Not 100% sure on that one. I'd have to look that up and get back to that participant.
Okay. And we'll have time for about one more. What are your thoughts on regarding the campaign hype of not taxing Social Security benefits in the future? Do you have any opinions on that?
Well, I would say that it doesn't really impact Social Security if they do that. It just impacts how much tax retirees owe at the end of the day. A lot of retirees already have tax-free Social Security because they're earning or their provisional income, excuse me, is under the threshold, so their benefit is tax-free already. So really what that rule would do, it would be giving higher earners, or not earners, but higher income individuals tax-free Social Security as well. Now, in my personal opinion, and I try and stay away from this a little bit, but to me, right now, we're trying to find sources of revenue in the federal government because we have a very large deficit. So further tax cuts to me personally don't make a lot of sense, but that's just an opinion.
Gotcha. Thank you, Ron. So we have one last question. This client is 60 years old.
Okay.
If the FRA on SSA.gov is in today's dollars, or should he factor in an estimated cost of living adjustment to make a prediction of what that would be at his FRA?
Yeah, good question. And they're in today's dollars.
Today's
So
dollars.
each year, Congress authorizes a COLA, a cost of living adjustment on Social Security, and his estimate would go up with that. So it's in today's dollars.
Okay. Awesome. Well, we're coming up with just a couple minutes left. I want to thank you, Ron, for your candor and comments, and we really appreciate everyone on the line today for your time. We hope